Welcome to our comprehensive guide to the 529 plan, your ultimate tool for college savings. In this video, we'll dive into what a 529 plan is, how it works, and why it's an excellent choice for funding future education. By the end of this video, you'll be equipped with the knowledge to utilize a 529 plan effectively for your family's future. A 529 plan is a tax-advantaged savings plan designed to encourage saving for future education costs. These plans, legally known as qualified tuition plans, are sponsored by states, state agencies, or educational institutions. There are two types of 529 plans: prepaid tuition plans and education savings plans. Prepaid tuition plans allow you to prepay tuition at today's rates for use in the future, while education savings plans work much like a retirement plan where you contribute funds that grow tax-free for education expenses. Let's look at an example. Imagine you start a 529 plan for your child when they are born. You contribute $200 a month, with an average annual return of 6%. By the time your child is 18, you will have saved approximately $76,400. But how is this money actually used? Qualified 529 plan expenses include tuition, fees, books, supplies, and equipment required for enrollment or attendance at an eligible educational institution. Room and board are also qualified expenses if the student is enrolled at least half-time. In recent years, K-12 tuition up to $10,000 per year and student loan repayments up to $10,000 can also be covered. One common question is, what happens if my child doesn't go to college? The good news is flexibility. You can change the beneficiary to another family member without tax consequences or penalties. Alternatively, you can withdraw the money, but you will have to pay income taxes and a 10% penalty on the earnings portion of the withdrawal. Here's another important consideration: state tax advantages. Many states across the U.S. offer some form of tax deduction or credit for contributions to a 529 plan. For example, in the state of New York, you can deduct up to $5,000 in contributions to a 529 plan from your state taxable income, $10,000 if married filing jointly. Next, we'll cover saving strategies. One effective strategy is front-loading your 529 plan. You can contribute up to $85,000 in 1 year per beneficiary without incurring gift taxes by using the 5-year election rule. This means you spread the contribution over 5 years for tax purposes. Let's address some frequently asked questions. Here's a common one: can I use a 529 plan for out-of-state colleges? Absolutely. Funds in a 529 plan can be used at any accredited college or university in the U.S., and even some institutions abroad. Now, let's discuss the impact of a 529 plan on financial aid. While a 529 plan is considered a parent asset and is counted at a lower rate in the expected family contribution (EFC) calculation, it still might reduce the amount of aid your child is eligible to receive. However, this impact is relatively small compared to not saving at all. In summary, the 529 plans offer a flexible, tax-advantaged way to save for education, with benefits such as state tax deductions, qualified expense coverage, and relatively minimal impact on financial aid. With strategic planning, a 529 plan can be a cornerstone in securing your child's educational future.